Good day, fellow investors. When you look at the market, stocks are down, but let me tell you, it's not tariffs. All the discussions, wherever you look, tariffs, 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 everyone is discussing tariffs, tariffs predicting a recession, but we'll see in the data, recession, stock market has nothing to do with tariffs. Let's just compare with what we had just 2.5 years ago. The stock market was down 25% in 2022 based on recession fears, where most people at the end of 2022 thought that the global economy will slow down, China, US, everything will be in a recession after the booming 2021. That didn't happen. And the result is this: stocks are up still since the end of 2022, 55%. Even better, if you look from bottom to top, is up 70% in 2 years. 70% in 2 years. Tariffs, whatever the media wants to fill your mind with, no, this is something. Stocks have been up 70% in just 2 years. And just a few months ago, all the Wall Street predictions were saying how the stock market will just continue to go up 10% per year. But if you look at earnings haven't done much over the last few years, are actually down from the great 2021. But stocks are up 70%. Valuations over the last 10 years went from 18 to 27, 28, thus 50% higher. Thus 50% of the gain of the stock market over the last decade is just from valuation expansion. And further, if you look at the 10-year treasury yield, which is the alpha and omega of valuation, it is now at 4.2%. Plus, it is unlikely that we will see the zero interest rates we have been accustomed to for a decade here in the 2010s. Now, it is likely that long-term interest rates will be a little bit higher. On that, you have to add the 2% stock market premium, which is the historical average. And then if you look at things, the current S&P 500 earnings yield is 3.6%. The average is there, 6-7%, in line with the current 10-year treasury plus stock market premium. And if the S&P 500 yield reverts to historical normality, so like it was June 2011, then we are looking at minus 40% just to be valued in line with the US Treasury. Let me show you this from a valuation perspective. You are now buying stocks here compared to the 2000 dot-com bubble, 1960s Nifty 50 bubble, 1929 bubble, and all those periods had terrible stock market returns going forward. So of course, a trigger can be tariffs, can be this, can be that, but the fundamentals are not lying. Stocks can only go up, and then at some point it is unsustainable for this to continue. Especially if you look at the economy, and the US economy has done well over the last few years, but 20% of the economy is government spending. The government is borrowing a quarter of what it's spending to, let's say, finance also the economy and everything. If you just borrow half of that, then 20% of the economy becomes 18% of the economy, and there goes your 2% growth, because it is made on debt, and it is an unsustainable path, and therefore also another factor that weighs on everything. So don't let be confused by the media. Tariffs, tariffs, tariffs. No, it's the fundamentals. It's simply the unsustainability of what we have had over the last 2 years. Normality, P ratio 15, given the 10-year treasury and the likely long-term rates, would be 3,000 points for the S&P 500. Thus, we still have 40% to go down. And look again at the long-term chart. So yes, stocks go up over time as businesses develop, inflation and everything, But do you understand that we are here to hear this is an exuberant, over the trend scenario, and just for normality's sake, usually trends revert to the mean. That reversion to the mean is what is happening now. Perhaps Q1 will be great because people are rushing to do purchases before tariffs, good economic numbers, which then means maybe a rebound, but it is all unsustainable for, let's say, the normal business stock market cycle. And it is likely that in the next few years, stocks return zero at best, with possible crashes to 40-50%. Thus, low returns, high risk. And that is not something I would like to be involved with.